The need to insure oneself from a precipitous fall in the stock market is never far from the top of investors' minds. In order to be able to provide this protection, ABSA have developed a product that gives investors exposure to the stock market, but with a degree of downside protection. But the question is this just a fad, or should it really be incorporated into investors' portfolios? Ryan Saido from ABSA joins us to make his case and, of course, to go beyond the product and talk more about trends in the retail environment and in the investment community as you see them unfolding at the moment. So before we get to your target return lock-in, right now, as we start the new year, how are investors out there feeling in terms of what you are assessing on the ground?
I think they've just come out of quite a long period of uncertainty, and that sort of that still prevails in a lot of the sentiment that we're seeing. So really, it's brokers, clients, the likes, telling us that we're long many portfolios are long sort of long positions only, and how can we really protect that? And whether it's local equity or offshore equity, we try and have a product out there that solves for many of those solutions. Now, the target return is coming off the back of a lot of research out of both ABSA Corporate and Investment Bank as well as ABSA Wealth, which is more the retail focused arm, that's saying a correction is looming and
is imminent. Beware, we're going to fall 40%. Well, no, you don't want to fall 40% because in this product you aren't protected if you fall more than 40%.
Well, slight correction there. If you fall 40%, you're okay. If you fall through 40%, then you
41 or 40.01.
Correct.
So I'm again, and Ryan, I'm always interested to find out the expectations of investors, because it seems to me the expectations of investors move contrary to the way the stock market moves. Mm-hmm. Last year we had 27% total return on the all share. Did that catch many of your clients by surprise?
Yeah, and I think it caught them by on the upside. I think they weren't expecting that. So a lot of them have had a pleasant surprise for a change. I think what a lot of them are now saying is, I've locked in that return, so how do I start to protect it now? And that's where we've come up with some sort of ideas to try and lock that sort of stuff in.
Now, just in terms of that, just the insurance that you've worked into this product, mm-hmm. what's covered and what's not, and what are you giving up in growth? Because we had a colleague or a peer of yours on from Stanlib who ran mm-hmm. absolute return funds,
yes.
and the reason why I was intrigued with this product is because it's similar to an absolute return fund in its purpose. So I wanted to just see what exactly is the investor getting here. Do they get unlimited protection to 40% as you indicated, yep. or what's covered and what's not?
Yeah, I think important to note that we term them structured products, but I actually prefer, well, the industry calls them structured products, but I prefer the term protected investments, because really they're a product set that sit in between your actively managed or ETF types, not long only, but open-ended investment vehicles, and your cash vehicles. So they're term-based investments where you take on issuer credit risk, in this case ABSA, right. But there are other prevalent issuers out there like Investec and RMB. But you take on issuer credit risk, and we try and play in the space between cash and long-only equity. So you do have a inherent capital guarantee in many of them, or what I term capital protection, because you're not guaranteed, because ABSA is not guaranteed to be there, the issuer is not guaranteed to be there. So we prefer the term protection. But what you are saying is we're giving investors a buffer where your long-only equity position is going to suffer losses from day one in a downturn. Your capital protected structured products, or your soft protected structured products, which is what the target return is, will give you a buffer before you start to suffer a loss. So in this case, the market has to have dropped through 40%, so lost 40%, and still be down at maturity for you to
What
lose
if the market
capital.
goes up another 22%?
Keeps going.
Yeah. 22% is what we added around that JSE All Share mm-hmm. for 2012.
Okay.
So what What is your situation if you buy into this product and we rally another 22%?
Clearly, we're positioning this not for the man in the street who thinks it's just going to run and run and run. So if you're a raging bull, excuse the pun, then this is arguably not for you.
Have you launched this because you are bears?
No, I'm not particularly, but our research is bearish,
showing that we need to beware.
And certainly the people we're talking to are bearish as well. Remember, a lot of the guys that we speak to are not. It's not a the size of the investment, even though it's a minimum investment size of 20,000 rand. We're talking to people in their 40s and their 50s and coming up to retirement, and the last thing they want to be doing is losing capital right before they retire.
Can I jump in here, Warren? You're chatting to a lot of investor managers out there on an ongoing basis. Is the sense, because I think this is the big debate point, is the sense that we are at the moment in a potential situation where the downside is more likely than further upside? Is that the overriding sentiment you're getting?
It's yes, to a degree. I think investment managers are saying that certainly the valuations in South Africa after last year, after the great return we had, are now pretty stretched. Whether that means we go off a cliff and we fall down into a very steep drawback is one thing, but certainly the perception is that there's more value offshore, and that's why many of the local investment managers have been using their offshore allocation to go offshore.
Indeed.
Whether it can make make the case for a flat-out bear market in the next 24 months is always hard to tell because the future is uncertain.
Mm-hmm.
But I wanted to know why specifically your research is saying that now would be a good time to lock in equity values. Is that tied to work that's been done offshore in Europe and the States? Or is that very much a South African factor at this point?
And it must be tied to a sentiment index of sorts.
Well, they've looked at it and said, strip out all the macroeconomic fundamental points that make up any growth or not in any market. And they've said, strip that out, and what's actually left in terms of pure sort of economic growth or fundamentals within the companies that make up the equity market, and there's not lots left. The main story is this market is growing on the back of positive offshore sentiment. They're starting to sort all their troubles out in Europe and America, and those markets are starting to grow, and ours just seems to be trending along with it. What they're worried about is that as soon as there's a blip, and there's many hurdles still in those economies that could provide that blip, is that it's going to have a multiple effect down here, and that's the correction that they're looking to this is looking to protect against.
And just in terms of the product, it's covering protection on the top 40. Is that right?
Correct. Yes.
Okay, so it's very much on the biggest companies, and many of those earnings are offshore.
Safe, yeah.
Okay.
They have a fair amount of their earnings generated outside of this country.
And it would also go back to the thinking that we are not an island. We are, of course, going to be impacted by anything that happens globally. And if we see another fallout, and it looks as though it could be imminent in Europe, that could be the catalyst for panic.
Increasingly so, as we become less and less emerging and more developed, we're going to follow developed market trends, and not to scare anyone, but those seem to be more boom and bust than what the top 40's experienced since its inception.
Ryan, the problem I have with these products is that they always tend to come at the wrong time, and the reason why they come at the wrong time is because the biggest falls, like we saw in 2007, 2008, are the ones that are unexpected.
Mm-hmm.
So when everyone's having a good time and equity markets are rolling, that's when we're supposed to get nervous, but none of us really do. And hence, product providers and research houses like yourself don't provide those products then, because there's no demand for them. If you had come to me in 2007 and said, I think it's getting a bit out of hand here, you might want to insure your portfolio, I don't think you would have got much interest. What's the sort of feedback been from your clients at this point, and generally for structured products in our market, which I think are fairly new in their conception?
Very much so. I'll touch on the second point first. It's very much a growing product set. I think the traditional unit trust unit trust managers had a pretty good time of it, given the nature of this market, and there's cost pressures coming in, and the Treasury is obviously very focused on low cost retirement savings initiatives. So we see things like, whether it be ETFs, ETNs, or even structured products that are, you know, there to protect capital, but are also very transparent and simple to understand. We see, though, a growth trend definitely in those product sets. The feedback from our clients on this particular product is, you know, this is the perfect time for it. We've not launched it post the fall. We've launched it before, and it speaks exactly to that research, to say, you know, we're not saying take your entire equity portfolio and stick it into something like this. We're saying you have household insurance just in case your house burns down. So
this is
stick
insurance
something
on your
into your
equity
long-only
portfolio.
equity portfolio to protect it, for sure.
You've got your colleagues at ABSA Capital have been fantastic in bringing out new ETFs, and you've referred to it a couple of times in this interview. Is there the possibility ABSA Capital and will be the first issuer to list this as an ETF for investors?
It would probably take the format of an ETN if it did. Remember, the one of the key sort of drivers and important reasons for structured products or structured notes in this regard is that they're quite easy to issue and quick to market. So you can take advantage for investors of a particular market cycle or a pricing point that may be very attractive. So, you know, is the target return something that's going to be available or should be purchased as a buy and hold for many years? Probably not. Something more generic, like the ABSA eRAFI, or Satrix have got their Divi Plus, those sort of things that would probably be more core in a portfolio, would be launched as an ETF, as an open-ended vehicle. And then we leave these more strategic, if you will, satellite structured products to pick pricing points and add alpha where applicable, or protect on the downside.
That's it, Ryan. Thanks so much for your time. Ryan Sato from ABSA Capital.